cloud? Just put it on the cloud. Perfect. Now you can share again.
Can everybody see my screen?
Yes, and we are on the top of the hour, so
Shall we
if you
get
want to go
started?
ahead. Thank you.
Yeah. Well, good afternoon, everyone. And thank you for dedicating some of your time this afternoon. Thank you, Dr. Chen, for inviting me to speak about year-end tax planning ideas and strategies. It's a small group, so hopefully we'll have some interaction, and please feel free to unmute yourself and ask questions midstream. I'm a big proponent of interactive teaching and interactive discussion because it enhances the learning and the understanding process. So I just have this disclaimer here for the recording. All I want to say about this disclaimer is all situation is specific, and the information I'm going to be covering, the tips, techniques, and strategies are very high level. So double check when you're consulting with clients, double check and make sure that the clients are discussing this with a professional tax advisor, whether it be a CPA or an attorney or an enrolled agent, etc. Today is November 12th, and it's Grace Kelly's birthday. And this was a very interesting tidbit to me. I hadn't realized that her parents had paid a $2 million dowry to the prince's family for him to get married to Grace Kelly. Apparently, Grace Kelly's family were very wealthy, and I did not know this.
That is a tradition for a lot of countries.
Yeah,
Where I come from, that is actually a tradition. So
yeah,
it's not very surprising.
Well, after I read this, I'm thinking maybe I should call my in-laws and
retroactive
and see what I can negotiate. After 18 years, I think they're going to tell me to get lost.
I wouldn't do that. That's a scary thought.
So, hi, welcome. Terry joined us. Hi. Okay, Linda's coming in too. Okay. So preliminary matters is gathering the information and having as much information available as possible. And having a copy of the prior tax return is really important because good information can be gleaned from the return, at least the 2019 return, but if you can get a copy of the 2018 return as well. Bank statements, reviewing transactions that have closed or also pending transactions, for example, any real estate sales that are in escrow. That's one. Also other transactions that could be contemplated, not only for 2021, but also into the future, such as the sale of a business. And then estimating income, future income, also good information to have handy because tax planning is not static. It could bleed into future tax years. And as we'll discuss, there's some uncertainty of what tax legislation is going to be in the next coming years. And I have some thoughts on that I will share with you in just a moment. Questions so far? Everybody doing okay? Okay. So we just had an election, and the press has called it, and they believe that President Biden is the president-elect. So most likely that's going to be the case, unless there's a miracle that could happen. No guarantees, but that's my prediction at least. The House of Representatives is under Democratic control, even though they've lost some seats, but they still appear to be have control of the majority, 218 seats. The US Senate is what's the question mark. And in order to have meaningful tax legislation that could go through much faster than typical is if the administration and both houses of Congress are controlled by Democrats. If the Senate, if there's a majority Republicans, even a simple majority, one seat, there could be some pushback back and forth between both sides of Congress, the House and the Senate, and in delaying or maybe modifying or tempering any future tax increases. So in my opinion, and what I predict is that for 2021, there's going to be a status quo. I don't think there's going to be massive tax increases as some are predicting in 2021. And the reason is that whoever is elected president and confirmed won't be sworn in until January 20th. And by the time they get everything organized and there's some legislation which has to be written originally in the House, then it goes to the Senate. It's not going to happen until the second half of 2021. If you look back to the Tax Cuts and Jobs Act, when President Trump was elected in 2016, he was sworn in January, but the Tax Cuts and Jobs Act was not passed until December 22 of 2017, almost a year later. And that's where there was a Republican control of all three houses. The president was a Republican, the House was Republican, and the Senate was Republican. And it took 11, 12 months to pass substantial tax legislation. So in my opinion and my guess is we won't see anything happen until late 2021. And this is another important point to keep in the back of your mind is that although there has been certain, in two or three instances where tax legislation has been passed on a retroactive basis, I believe that any legislation that is passed will be on a prospective basis. So the earliest we're looking at any tax changes, increases, as a lot of people are predicting, is going to be effective January 1 of 2022. So with that, let's move on to some specific tax planning ideas. I split it into two components, individuals and businesses, and we'll spend most of our time on individuals. And I included ideas for businesses as well, so you can have it here in the slides, which I will share with you. So you have it as a reference at the back end of the PowerPoint slides. So let me go over this list quickly, and then we'll do a shallow dive on each one of these items. And if you'd like me to expand on them, feel free to stop me with questions. So deferring income and or accelerating income. And what I mean by that is accelerating income into 2020 or deferring it and pushing it forward into 2021. Same with deductions, accelerating deductions, taking deductions in 2020 or deferring them to the future, to a future tax year. The tax rates and taxation of capital gains vis-a-vis tax loss harvesting and how some losses could be triggered this year or delayed for next year to absorb some of the capital gains. And the reason why I have tax rates and tax brackets in parentheses is we always have to be cognizant of what the tax rates are going to be. It's a very challenging task akin to having a crystal ball, but having a knowledge of understanding of where rates are or where we think rates are going to be, even guesstimating sometimes would be helpful in the analysis and the planning and on the planning side. Increasing 401k contributions before the end of the year. IRA distributions, they're waived, but I have some thoughts on that point that I'll expand on. Splitting IRA deductions, Roth conversions, and then reviewing income tax withholdings through the tax withholding estimator. So let's do a little bit of a dive into each one. Let's look at this fact pattern to illustrate how deferring or accelerating income would work. Let's assume that we have a married couple and we estimate their taxable income for 2020 to be about $150,000. The $150,000 falls in the 22% tax bracket. And if you focus on this slide here, this is a tax bracket for 2020. And if you look on the left are the brackets. If you go down, the third line item there is 22%. And then the columns are the filing status. And the third column is married filing jointly. If you look down, 22%, it's income between $80,251 to $171,050 is going to be taxed at the 22% rate. So if there's any expectation that this family will have more income in 2021 or the future or future years, or tax rates are going to increase dramatically for this tax bracket, this couple could accelerate income into 2020 and pay tax on that income at the 22% tax bracket. And this works in conjunction with also with required minimum distributions and also Roth conversions. And I'll show you my thinking and how those two link together shortly. Second, accelerating deductions or deferring them. Again, very heavy tax rate specific. The thinking always is, let's reduce paying taxes now because of time value of money, and that makes a lot of sense. But if tax rates are going to be drastically higher for individuals in similar tax brackets, then it may make sense to delay deductions. So keep that in the back of your mind. And what am I talking about here by accelerating deductions? We're talking about prepaying mortgage interest, charitable contributions, prepaying property taxes. We all know that under the Tax Cuts and Jobs Act, the state tax deduction for individuals has been capped at $10,000 for single filers and also for married filers filing jointly. So any tax prepayments that are over $10,000 would not be of any help to taxpayers at the federal level. However, for states that have income taxes, like California, very high income taxes, that allow a deduction for property taxes, accelerating a property tax deduction would be helpful for California income tax purposes. I also want to mention and remind everybody about the standard deduction that have been increased because of the Tax Cuts and Jobs Act. So for individuals who have miscellaneous itemized deductions that are less than the standard deduction, it does not make sense to get benefit for the deductions, because the higher the amount, the more benefit the taxpayers are going to get from these by taking the standard deduction. However, if there's opportunities to bump up the itemized deductions in 1 year versus another, that an amount that's more than the standard deduction, that may be helpful, and that's where the bunging the charitable deduction comes in. Capital gains are taxed. There's 3 different tax rates that apply to capital gains. It's actually 4 if you think about it: 0%, 15%, 20%, and there's the 3.8% net investment income tax, or the NIT. Sometimes I call that the Obama tax because it was put in place during President Obama's administration, which could place a 23.8% tax burden on capital gains. And the rate depends on the income tax brackets of the individual taxpayer. So with that in mind, how can tax loss harvesting help offset some of the gains? If individual taxpayers have assets that have depreciated in value, the stock market is just out of control, but there's some stocks that have lost value. For example, oil and gas stock, restaurant stock, and cruise ships have been harmed. And if clients have those stocks that they've been holding on to and have not sold and did not sell those positions in February, it might be an opportunity to dispose of those positions and trigger a loss. The nice thing about capital losses are, if they're not used in any one tax year, they could be carried forward indefinitely. Indefinitely, not forever. They can be carried forward until the owner of those tax losses or the taxpayer dies. So I guess they could be carried forward till the end of that person's life. Monitoring, looking at the investment portfolio to see some specific positions that could be disposed and to offset some capital gains might be an opportunity for planning. Now, again, if the taxpayer anticipates being having a higher amount of income that could push them to the 20% plus the 3.8% tax bracket, maybe holding on to those losses and triggering that sale in 2021 may be more beneficial, because offsetting income or gains that are taxed at a higher rate would provide more of a benefit than the opposite. Keep that in mind as you're looking and analyzing these things. Now, the other point about tax loss harvesting is the wash sales. This is not the washer and dryer where you do your laundry. Now, this relates to selling a security at a loss and purchasing the same security either 30 days before the sale or 30 days after. And if that happens by an individual taxpayer or a married couple, then they are not allowed to use that loss to the extent the same security was purchased. And this becomes important with taxpayers that have brokerage or financial accounts at multiple institutions. Accounts that are being managed by one financial advisor at the same institution. Usually a financial advisor and the institution capture these wash sales and report them accurately, for the most part, on the 1099s. But if there's someone who has different accounts at different places and one financial institution doesn't know what the other is doing, it falls under the advisor to make sure that the taxpayer is not violating this wash sale rule. Increasing 401k contributions. The limits for 2020 is 19,500 and a 6,500 catch-up contribution for people over 50. So if you have clients who have not taken advantage to contribute the maximum, whether it's a pre-tax account or an after-tax, a Roth 401k account that some companies have, that's an opportunity to increase the savings. There's not that much time left. There's maybe 2 or 3 paychecks. But some companies, and I don't know if it's going to happen this year, but some companies pay bonuses at year end. So some of that bonus could be contributed into a 401k so long as the contribution rate is increased. I also included a graphic for the 2021 marginal rates. They're very similar to the 2020 rates, except for the inflation adjustments in the tax brackets. It's available here for you as a reference. Okay, minimum distributions. Now, for individuals who are 59 and a half, if we go back to the accelerating deferring income example, for individuals who have steady income and they don't have a lot of transactions, it may be difficult to take advantage of this idea of accelerating income to pay tax at the lower tax rates. But for individuals who are 59 and a half or older, or for those who have been taking out minimum distributions, there might be some planning that can be done, even though required minimum distributions were waived for 2020, but they are not prohibited. So there's a possibility to take out a distribution. Doesn't have to be the pre-calculated RMD amount. It could be any amount. It could be less than that amount, or it could be more than that amount. And also for those that are over 59 and a half, can take out distributions and have them be taxed at a lower tax rate and not be subject to the early withdrawal, the 10% early withdrawal penalty. So even though individuals are not over 70 and a half or over 72 now, for those who are between 60 and 70, and they have a low income year, they could take out a distribution now out of their IRA or their retirement account. And this also goes hand in hand with Roth conversions to take advantage either of the lower tax rate, and the funds could be kept in reserves to pay for living expenses, or they could be converted. Now, RMDs cannot be converted typically, but this year there are no RMDs, so any distribution coming out of an IRA could be treated as a Roth conversion. And the conservative view, more beneficial, tax beneficial view is for individuals to pay the tax on conversions from outside resources and not to use funds from the IRA to pay the conversion. Those who have the wherewithal to make those tax payments can convert a larger amount. Of course, they have to be comfortable with how much tax to pay now. And since everybody in the world believe tax rates are going to go through the roof, this may make sense. Now, I'm not of that belief. I think conversions are very fact and taxpayer specific, and they have to be looked at very carefully. And individuals similar to the example that I went over earlier, and let me go back to this chart here. I'm not of the opinion that tax rates are going to be drastically higher for individuals and families that are in the lower tax brackets. I think tax rates are going to go higher for individuals in the higher tax brackets. So it may make sense for those individuals to look at conversions. It makes sense for everybody, and the amount is important, but for some taxpayers, it'll make more sense than others. The tax withholding estimator is a tool provided on the IRS website that is available for everybody. And that information could be fed into that calculator to determine if there's withholdings, if the federal income tax withholdings are adequate, or they have to be increased, or there's potential to be reduced. As you're doing tax planning, don't forget about the Medicare modified adjusted gross income premium penalty. And for 2020, for married filing taxpayers, that amount is $174,000. And the big difference between modified adjusted gross income for that is taken into consideration to compute the Medicare premium increase is, and the regular adjusted gross income that you see as a line item on the federal income tax return, is that the MAGI includes tax exempt income, tax exempt interest, and tax exempt dividends. So those factor in, and they have to be added to the adjusted gross income that's reported on return. So if individuals have high income, even though some of it is tax exempt, where they don't have to pay income taxes on it, they may still be subject to the Medicare increase in premiums. And it could go up very, very quickly. The net unrealized appreciation is a very fact-specific planning opportunity, and this can be used for individuals that are working for large companies that have employer stock in the 401k plan that I'll cover in just a moment. Coronavirus-related distributions that was passed as part of the CARES Act, and I'll go into specific details on that. Opportunity zone investments. A risky proposition, but very, very powerful from a tax payer-friendly perspective. Charitable contributions, we discussed that briefly earlier with in the deductions tab, but we'll get into more specifics. And then qualified charitable contributions out of an IRA, and then some discussion on estate and gift tax planning. So the net unrealized appreciation are for individuals who are retiring or have been laid off, and they have employer stock in their 401k plans. And there's some very strict IRS Internal Revenue Code provisions that have to be complied by. And this is the planning idea around it. When the holdings of the 401k are distributed, the employee pays ordinary income tax on the cost basis of the shares, but capital gains tax on the appreciation. So typically when funds come out of a 401k, 100% of it is taxed at ordinary income rates, so long as the funds are contributed on a pre-tax basis. But there's this opportunity for stock of the employer. Very fact specific. If you have a situation that applies, it's a very, very taxpayer friendly planning idea. Coronavirus related distributions. Now, there's been severe impact in certain industries, and financial advisors highly recommend not touching retirement plans or not taking distributions out of retirement plans early and letting that grow. But if the choice is between paying for food, shelter, and clothing or not, and the only option is to take a distribution out of a retirement plan, this provides a very helpful benefit. So it's not available for everybody. Qualified individuals can do that, and qualified individuals are folks that have been affected by COVID, or they have a family member who was sick, and or they've had a severe decrease or decline in income as a result of the pandemic. So from a mathematical perspective, up to $100,000 could be taken out as a distribution. There's no early withdrawal penalty, so no 10% penalty for those under 59.5. And there's a repayment option. The amount, if it's repaid, and there's two options for repayment: 100,000 immediately or soon after the distribution, or the other option of repayment is over a 3-year period. If the funds are repaid, then the distribution is not considered income. Otherwise, it has to be reported as income, and income taxes have to be paid on it. Now, the repayment option that is done over this 3-year period, if the repayment is made of any amount that is after the filing of the 2020 tax return, the distribution has to be reported as income on the 2020 tax return. Taxes have to be paid on it. And then when the repayment is made, the taxpayer can file an amended 2020 return to get a refund of the taxes. So this creates a cash flow challenge for some people. I mean, trying to repay the amount is going to be very challenging. But in addition to that, the timing of the repayment could create cash flow challenges as well. Opportunity zone investments. These are risky, and they have to be vetted to make sure that from an investment perspective, it makes sense. They provide very valuable tax benefits, but the investment has to make sense. It has to make sense from a financial perspective. So what is this? What do opportunity zone investments provide in terms of a tax benefit? They allow a taxpayer who's recognized capital gain to defer that gain until 2026. If the proceeds of that sale are reinvested into an opportunity zone investment, opportunity zone investments have to be investments in certain low income areas, specifically designated low income areas. And they're available across the country, and a lot of partnerships and limited liability companies have been formed by investment houses to facilitate these types of investments. If this investment is held by the taxpayer until 2026, there's the opportunity to defer the entire amount of gain. If the investment is made before December of this year, 10% of that gain is excluded. The remaining of that deferred gain has to be reported in 2026. Taxes have to be paid on it. But if this same investment is held for 10 years, anything above that, anything above the original investment, future appreciation is 100% excluded. Let's focus on the charitable contribution. The CARES Act put in a small nugget for taxpayers, for moderate income taxpayers who benefit from the standard deduction. The CARES Act allows a $300 deduction above the line. And what that means is that even if individuals who are not itemizing and who are taking a benefit for the standard deduction are able to deduct $300 of charitable contributions against their taxable income. Now, this $300 is not a credit, so it does not reduce the tax liability dollar for dollar. So the tax effect benefit is going to be much smaller than $300. But for those who have not made any charitable contributions by the end of the year and they're willing and inclined to support some charities, especially during this holiday season, I highly recommend them to make this charitable contribution because it provides a small tax benefit to go along with the charitable feel-good contribution. The CARES Act also increased the charitable deduction limitation. If you recall, the most common limitation is 50%, where if taxpayers make donations to recognized charities, they can only reduce their adjusted gross income by 50%. Anything above, any donations above that amount have to be carried forward to future tax years. It can be carried forward for up to 5 years. But with the CARES Act, 100% of the adjusted gross income could be deducted in the current year. And this helps charitably inclined taxpayers. It could also provide a benefit for taxpayers who have made commitments. For example, there's some taxpayers who do not want to give a gift in 1 year, but rather want to spread that gift over a number of years, 3 years, for example, or 5 years. They make a pledge in year 1 and say, okay, we're going to meet this pledge as a donation 20% a year over this 5-year period. And taxpayers who are in that situation could, and who have who are making those pledges in cash or in property, appreciated securities, in the next bullet point, can accelerate those donations into 2020 to take advantage of this and eliminate or substantially reduce their adjusted gross income. Donation of appreciated marketable security is always a very, very popular way to gift, to make a charitable gift. And it provides a more tax efficient benefit where the securities are not sold, capital gains are not recognized, taxes paid. It increases the amount of the gift of the donation by the taxpayer. And also donation of personal property, collectibles, paintings, etc. That's always an option for certain taxpayers. Qualified charitable distributions, the QCD, that's been around for a while, and it applies for taxpayers that are 70 and a half or older. Even though required minimum distributions in the Secure Act increased to 72 years, they did not change this specific rule. So an IRA owner who's 70 and a half or older can direct up to $100,000 to charity. Now, in other years, in prior years and in future years, this QCD would reduce the required minimum distribution, but not this year since RMDs have been waived. But they do reduce the balance in the IRA account, which may reduce future required minimum distributions. Again, up to 100,000 can be directed, and this is only applicable to IRAs. Estate and gift tax planning. Well, there's a lot of changes expected in this area. The current applicable exclusion amount is 11.58 million for 2020, which was increased to 11.7 for 2021, the inflation adjustment. But there's a lot of discussion that will be reduced. It's automatically going down to 5 million inflation adjusted. In the which will most likely be somewhere around 6 million. But President Obama and Joe Biden, when he was vice president, there was discussion of a 3.5 million applicable exclusion amount. And although Biden hasn't come out and said that officially, I know he really likes this $3.5 million. So for decedents dying, that married couple, family that have more than $23 million, that represents about 1,800 to 2,000 decedents in the US who fall in that category and have to file an estate tax return, pay estate taxes. Out of about 320, 325 million people in the United States, only about 1,800 to 2,000 returns are filed. But when the exclusion amount drops to 3.5 million or 7 million, that's going to impact a lot more people, especially people that live in the metropolitan cities that own real estate. Most families could easily have net worth in excess of 3.5 or combined of 7 million. So tax planning is going to be very important. And estate planners are very busy between now and the end of the year, advising clients of various gifting strategies, whether it's through trusts or non-grantor trusts. As I mentioned earlier in my first slide, I believe that the any legislative change to this will not be retroactive going back to 1/1/2021, but will be prospective, effective 1/1/2022, if any. So I believe that most taxpayers will have another year or so for planning purposes. And so for those who have net worth between 3.5 million and 11 million, or between 7 million and 22 million, so planning becomes more important now that it's most likely that Biden is going to be the president. The $15,000 gifts, most of you know about this. The wrinkle with this is that the beneficiary family members who receive this gift have to cash the check before the end of the year for the gift to qualify as a 2020 gift. And if it's at $15,000 or below, it will not count against the 11.58 million exclusion amount. 529 contributions, also a great way to deplete an estate, especially if grandparents have children who have many grandchildren, and there's an opportunity to front load the 529 plans. And you're multiplying a 529, a front loaded 529 plan times 3 or 5 or 8. And so that helps reduce somebody's estate very quickly. Family loans, given the very low interest rate environment, the AFR is at an extreme low at the moment. So good opportunity to make family loans, either to support family members and use that as a gifting option as well. There's a lot of other estate planning strategies, defective grantor trusts, grantor retained annuity trusts, charitable remainder trusts, etc. And on each one of these items, we could have at least a 1 hour, maybe more, webinar to discuss each one of these topics. So all I'm doing here is I'm scratching the surface and giving you some highlights for you to use and providing you with this list as a checklist. For those of you who are in other states, there's 14 states that have a state estate tax and 6 that have inheritance taxes. So keep that in the back of your mind if you're advising clients and they're attorneys who reside in the states where there's an estate tax. The estate tax is paid by the estate itself, whereas the inheritance tax is paid by the recipients or the beneficiaries who receive the gifts from the estate. And the limitations, the exclusion amount, these states have exclusion amounts as well, but most of them are very, very low, like 1 million, 1.5 million for these states. So the estate taxes could apply at a much, much lower level than the federal estate taxes would apply. Relocating the QBI deduction, health savings accounts, flexible savings accounts, and Medicare Part D plans. Let's spend a few minutes on each one of these. Relocating. This is not a year-end planning per se. This is more of a long-term planning strategy. I have it here for you to start thinking about. If it's a lot of research and analysis has to be done. And there's two types of relocations. Personal, in other words, moving, packing up and selling your house and going to a no income tax or low income tax jurisdiction and living there permanently. And then the other one is moving your net worth or your wealth, primarily your liquid assets, to a trust that's based in a no income or low income tax jurisdiction. Personally, moving requires a lot more research, a lot more planning than moving assets into a trust. But there are options. There's 7 states that don't have an income tax, and there's 2 of them that don't have an income tax but tax portfolios. Some states are better than others. For example, Nevada, Texas, Florida, Washington State, there's no income taxes. Alaska, there's no income tax, but I don't think a lot of people want to move permanently to Alaska. I think Nevada or Austin, Texas might be a better option than moving to Alaska. The qualified business income deduction is around, I don't know what the status is going to be of this deduction, whether it's going to stay or it's going to be modified or it's going to be abolished in the new administration. But this is a 20% deduction on qualified business income. It's a very helpful deduction for taxpayers. And you have to be careful when the individual taxpayer, the client that you have, is earning income for a specified service, trade, or business. Specified service, trade, or businesses are income earned by most professionals, lawyers, accountants, doctors, dentists, insurance professionals, financial advisors. Most licensed professionals, income is considered SSTB, and there's limitations on the benefit of this QBI deduction, where at certain income levels, if the taxpayers have a certain income, taxable income amount, they cannot get benefit of this QBI deduction. So when you're thinking about accelerating income or deferring income, keep this in the back of your mind and make sure that the taxpayers are within this income threshold so they can get benefit for this QBI. Health savings accounts. I recommend whoever has a health savings account to fully fund them before year end. Now, this goes hand in hand with a high deductible plan. So you have to have a high deductible plan, but it provides a nice benefit because distributions to pay medical expenses out of an HSA can be made on a tax-free basis. And for those who are 65 or older, they can take out distributions out of an HSA to pay for all expenses, not just medical. They have those distributions, the non-medical distributions, are subject to income tax, but for those that are 65 and older, there's no early withdrawal penalty, the 10% penalty. So the HSA kind of functions as a hybrid IRA, if you will, where the funds could be invested in securities and could grow. And obviously, it would benefit those who are not taking advantage of the funds that are in the HSA so that it grows over the years. And HSAs could be funded even if there's no, the taxpayer does not have earned income, as opposed to an IRA where there's earned income is required to be for the individual to be able to make an IRA contribution, whereas with an HSA, it's not. Flexible spending accounts, they're use it or lose it plans. So if there's, for those who have funds in their flexible spending accounts, I recommend that they take out distributions right away and spend them on allowed expenses, medical expenses primarily. I'm at the business section. I could continue or I could stop it here and entertain questions.
Got a couple of questions.
Go ahead.
First, for the gifting of personal property, what kind of evaluation do you need of like collectibles or whatever? Is there documentation that requirements that we should be aware of?
Yeah, for an appraisal is required. And for gifts that are over $5,000, the appraisal has to be attached to the tax return.
Okay.
And for all gifts that are over $500, there's a special form, Form 8283, which is the contribution of personal property, has to be prepared and attached to the return. For those gifts where the appraiser has to be included, the appraiser and the charity must sign that form.
Okay. And these
So,
have to be qualified charities?
correct.
Okay. And the second question I had is about a timeline of when you must recognize an investment loss in order to carry over that loss. More specifically, something just landed on my desk this morning where a client gave $100,000 to a stadium seat company that was going to pay him some sort of return. Never happened, can't contact the company. He hasn't recognized the loss anywhere on paper yet, but the investment happened in 2014. And I looked at his tax return and he hasn't declared it. He's not carrying over any losses. Is it too late?
It depends on when the possibility of receiving a benefit expired, if you will,
Yeah.
for lack of a better word. So, in other words, when was there, when the investment was made in 2014, this individual had an expectation to receive some benefit.
Right.
The closing of this loss, if you will, happens in the tax year where that expectation went away. And there's been a lot of litigation in this area, not litigation specific to your example, but litigation as far as when that expectation, when the taxpayers lost that expectation of receiving or getting the income benefit that they were looking for.
Okay.
And obviously, and I'll tell you what the friction is going to be. If the taxpayer takes this loss in 2020, it says, okay, well, in 2020, I decide, I'm not gonna, there's no way I'm going to be getting any benefit from these folks. So I'm going to write it off as a loss in 2020. Upon examination, the IRS could say, well, we think that this should have been a loss reported in a prior year, 2015 or 2016, because you should have known in that year that you weren't going to get a benefit, but you held on to it, and now you want to do some planning and take the benefit in 2020. So that's where the friction happens between the taxpayer and the government agency. So my recommendation would be to document the reason why this taxpayer believes that 2020 is the year where this loss should be taken.
Okay, and can he go back and adjust some prior years if that
Yeah,
makes more sense?
Yeah, if the years are open.
Yeah, that's the question. One of the things in reading the document, it talked about that they could continue this arrangement beyond their initial scope without just a verbal agreement. So there's nothing documenting that it actually ended at any particular time, according to the written agreement, but who knows? You know, that's all subject to interpretation, I guess.
That's right. That's right. My recommendation would be documenting everything as best as possible.
Okay, thank you.
To support the taxpayer's position, obviously, because you're representing the taxpayer client.
Thank you.
Are there any material differences between that situation that was just discussed and forgiving debt?
Yeah, the debt forgiveness, there's some situations where the write-off of the debt could be treated as an ordinary loss, which would offset ordinary income. And the taxpayer has to be in the business of making loans. And if there's some bad debt where there's a loan that was made and there was some bad debt and that bad debt was written off, that write-off would offset ordinary income. Whereas if you have an individual who just made a loan, just one-off loan to a friend, legitimate loan, documented, and hopefully some payments were made on that loan, and there was a bankruptcy, for example, or the loan has become uncollectible for various reasons, the write-off of that loan would be capital because the taxpayer is not in the business of making loans.
Okay. But as far as the timeline, it's going to be very similar, I'm assuming.
Correct.
Like at what point, right? At what point do you?
Yeah, the loss or the expectation of recovery has to be certain. It doesn't have to be 100% accurate, but the taxpayer has to be able to defend their position that the year in which they're taking the loss is the year that the loan became uncollectible, or the investment went under, if you will.
Mm-hmm. Great, thanks.
Mm-hmm. Let me just make one quick comment about the businesses here. The list is here, and I just want to draw your attention to the NOL, the 5-year carryback that was put in place by the CARES Act. Tax Cuts and Jobs Act had eliminated carrybacks, but now they're back, and losses, business losses, or as accountants like to call them, net operating losses from a trade or business can be carried back for 5 years, and these would be losses generated not only in 2020, but in 2019 and 2018. So if a taxpayer had a loss in 2018, that loss could be carried back to 2013. And there's ways to report that information to the IRS and get a refund. This was put in place to, as a result of the pandemic, to help certain businesses get refunds and help with their cash flows. The other point I want to make are the PPP loans. I don't know if you or if you have clients or anybody you know got a PPP loan. There's a tight time limit on the forgiveness of those loans. I just have it here so that you are aware of it, aware of that timeline. And special applications have to be completed and filed with the financial institution so that the taxpayer can get that loan waived. We're almost at the top of the hour. Here's my contact information. You're always welcome to call or email me. And I'm happy to discuss tax and estate planning and other comments or questions that you have.
Thank you, Hratch. That was highly interesting.
Thank you for your attendance. And
Very
I'll
well
stick around
presented.
for a few more minutes. Let me see how I can stop the recording here. I have to stop sharing and